this pullback is heaven sense. I'm a saver in gold, which means I'm fairly price insensitive. Why silver runs the way it does, but I've noticed that momentum has to be established by gold. When the momentum established by gold draws the generalist into the metals market, silver tends to outperform. My suspicion is because of its reputation for volatility, but also because of its lower unit price. Like 10 days ago, I saw some data. Physical silver importation into India is at multi-year high. If they hate silver, if silver becomes hated again,
you're going to start buying?
For most people, if they're buying physical gold, spot is a reference price at best. At the federal level now, we owe almost $40 trillion. Net present value of unfunded entitlement promises, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number's $120 trillion. So if you add that 40 trillion to 120 trillion, 160 trillion or something, the Internal Revenue Service says the private net worth of American citizens is 172 trillion. So there's only $12 trillion left over.
We're looking at all of these numbers. And of course, spot gold contract. It is my personal bugaboo. I wish they would put spot gold contract on it. No, they put gold, they put silver because they want you to believe that that's its true value. And so in this trading capacity that we have in this world, everything is a big trade these days.
Right.
The normal public sees the pullback they saw the run up in the spot prices and they're like, oh, isn't this fabulous? And I kept saying, you got to understand what you're looking at here. So now with this pullback, people become nervous. Oh, is gold investable? Can you elucidate on your thoughts on that little period?
Well, first of all, there is no price close to the current price that would cause me to be a seller. So the only price action I'm interested in is lower. I'd like to own more. For me, this pullback is heaven sense. I'm a saver in gold, which means I'm fairly price insensitive. A speculator might feel different. Somebody who's leveraged long futures contracts or something, they might feel different. But a saver likely welcomes the lower gold prices. If the discussion that you and I have been having comes true, which is to say if the U.S. dollar loses 75% of its purchasing power and gold maintains its purchasing power, there's no reason I can think of why people who can afford to wouldn't want to be buyers. And in that sense, they're served by lower prices. Too, that even the spot, particularly the London reference spot, is arbitrary.
Right.
And most investors can't buy at spot anyway. They buy at spot plus 5 or spot plus 5.5.
Markets celebrate rising gold until they're forced to ask why the paper quote and physical reality keep drifting apart. As Rick Rule points out here, price declines only matter if you believe spot is the asset instead of the reference mechanism around it. The overlooked detail is that most physical buyers never transact a quoted spot anyway, meaning public sentiment is reacting to a number many investors never actually touch. For wealth preservers, lower prices can be accumulation windows while leveraged participants are pushed out. Next, Rick Rule exposes why institutional pricing conventions quietly depend on investors confusing liquidity with value.
They sell it back to the dealer at spot -3, spot -3.5. There are products, if you're willing to take certificated products like my former employer's gold trust, where you can narrow the spreads. But for most people, if they're buying physical gold, spot is a reference price at best.
At best. And it is definitely, in my humble opinion, not a reflection of the true value of either gold or silver. Take your pick in the physical world. And I wouldn't I'm not a trader. I don't have that mentality. I mean, I had my license. And so, of course, as a young stockbroker and you're watching the options markets, you play a little bit, but I'm telling you, it takes a certain mentality and you've got to be prepared to just sit there and no. I like long-term strategies. It enables you to sleep at night. You just set a focus. You make sure you know what's going on. But, you've spent decades studying these cycles. And what do you see upcoming? You know, you were talking about what you think is going to happen with the spot price of oil too. I mean, both of these are, well, oil's a diminishing asset, silver's a diminishing asset, gold is all recoverable. But, you know, I don't really care in dollar terms. Part of what I'm trying to figure out how to do, and maybe you know how to do this already, is you brought it up earlier about you're looking at things in nominal terms, like the stock market's making new highs every day, a new high, a new high, a new high. And then you look at it in terms of inflation, and those numbers are a whole lot lower.
The fastest way to lose purchasing power is celebrating nominal gains while ignoring what those gains still buy. According to Rick Rule, long-term positioning matters more than reacting to every price swing, because quoted performance and real purchasing power are not the same measurement. The institutional advantage often comes from keeping investors focused on dollar highs instead of inflation-adjusted outcomes. If your portfolio rises 20% while your cost base compounds faster, the scoreboard is lying. Next, Rick Rule reveals the hidden comparison that turns record highs into quiet losses for long-term savers.
Well, can you put into perspective gold and silver and inflation?
Only that gold in particular has done well over time when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments.
Mm-hmm.
The correlation with silver has, I think, been less precise. In my lifetime in precious metals markets, I've been in them for, I'm embarrassed to say, 50 years now.
You should be proud to say that, not embarrassed.
That's right. You know, I hadn't thought of it that. As long as you're on the north side of the grass, you should be grateful. At any rate, my experience tells me, I'm not sure why silver runs the way it does, but I've noticed that momentum has to be established by gold. When the momentum established by gold draws the generalist into the metals market, silver tends to outperform. My suspicion is because of its reputation for volatility, but also because of its lower unit price. Recently, like 10 days ago, I saw some data that said that physical silver importation into India is at multi-year highs, and that would tend to suggest that the Indian peasantry is concerned again about the maintenance of their purchasing power in rupiah, for good reason.
Yeah, for very good reason.
And there's probably 300 million people in India who can't afford to save in gold, so they have to save in silver.
Mm-hmm.
I'm making this up, by the way. I don't know that to be true, but I have noticed in prior markets that momentum is established by gold. And when the generalist comes into the space, and I'm referring broadly to the Indian peasantry as generalists, that leadership changes from gold to silver.
Mm-hmm.
And for myself, I save in gold. I don't invest in gold or speculate in gold. I save in gold.
Markets usually think silver leads the story, but history often shows gold opens the door and silver arrives when attention turns speculative. What Rick Rule is highlighting is a pattern many overlook. Momentum in precious metals tends to begin as a purchasing power defense before becoming a broad participation event. That shift matters because retail usually enters after institutional conviction forms. For investors protecting wealth, the timing gap can determine whether volatility becomes opportunity or regret. Next, Rick Rule walks through the exact point where monetary fear turns into speculative acceleration.
Me too.
So it occupies a very different bucket for me.
Mm-hmm.
And I have, in the past, speculated in silver. My silver speculation had to do with the fact that for a long time it was a hated asset class. And my belief was that gold would run, and when gold ran, the silver would run, and it would become unhated. Well, that occurred. And so I sold 80% of the silver I had in my speculative bucket. May return if in some future conference, we notice in the attendee notes that they hate silver. If silver becomes hated again,
You going to
I'll
start
likely be
buying?
buying it.
Well,
Lynette, at one point in time, I was a stockbroker too, albeit a long time ago, and I owned a
right,
little
a long
brokerage.
time ago.
One of the things I did, owning a brokerage firm, is I went in the cage at the end of every trading day, and any day when buy tickets overwhelmed sell tickets, 4-1 or better, I'd make myself sell something the next day. And
Interesting.
anytime
Yeah.
sell tickets overwhelmed buy tickets, 4-1, I'd make myself buy something the next day. I'm not a trader at all. But what I learned is even in a reasonably high volume retail brokerage firm, you have enough data that
Mm-hmm.
you can trade against overbought and oversold circumstances. And that's sort of the way I speculate. When silver earlier in this year, in January, was in that wonderful to some melt up phase, what I've learned, and I'm sure you learned this as a stockbroker too, is that those hyperbolic up moves, what the Canadians call hockey stick charts, resolve themselves unpleasantly for the longs,
Yep.
as do hyperbolic declines.
Yep.
And that's the only kind of trading I can do.
The crowd thinks momentum confirms safety when it often signals exhaustion. Rick Rule's argument suggests that hated assets and loved assets create opposite opportunities, because emotion compresses judgment at both ends. The overlooked signal is not price alone, but participation intensity. When everyone agrees, the asymmetry disappears. Long-term investors survive by separating savings behavior from speculation, rather than blending both into one decision. Next, Rick Rule exposes why crowd conviction has historically been a worse indicator than volatility.
You have to give me something very, very obvious for me to make money as a trader.
Well, I'd agree with that. It takes a certain mentality to do it. And yeah. But, you also, I think it's interesting because we have a phenomenon that's happening right now with all these hyperscalers coming out with and selling equity, and buy and selling debt and all of that. What do you make about that? I mean, if you're looking back on history, what other period of time could you maybe liken this to, or nothing? Just a comment on where are all these trillions of dollars coming from for these hyperscalers?
That's a really good question. And again, the honest answer is I don't know.
Right.
What I've learned to do is stick to what I do.
Mm-hmm.
So when people ask me to comment on whether, say, NVIDIA is overpriced, I have to say I don't know. I can price natural resource companies. I can price conventional financial services businesses, banks, wealth managers, asset managers, insurance companies. But I don't know how to price technology companies, so I can't tell you if it's reasonable or if it isn't reasonable. And to be honest with you, I don't care. I'm reminded by my mentor, Peter Cundall, who said there's always something to do somewhere if you stick within your own circle of competence.
Mm-hmm.
Buffett has said the same thing.
Mm-hmm.
He has no fear of missing out because over time he's done fairly well doing what he knows how to do. I have suspicions which I will share with you, Lynette, and I hope that nobody loses any money based on these suspicions.
Right.
One suspicion is that if as much capital as looks like is going to be thrown at AI and data centers.
The biggest bubbles rarely begin with irrationality. They begin with capital becoming too available. This is where Rick Rule's thesis shifts from prediction to discipline, by refusing to price what falls outside his circle of competence. Institutions often win, not because they know more, but because they ignore more. For portfolio defense, avoiding forced opinions can protect more capital than chasing the hottest narrative in the market. Next, Rick Rule reveals the hidden assumption underneath the AI capital boom that almost nobody stress tests.
Is thrown at AI and data centers, that we will find a way to build them and build that capacity more cheaply.
Okay.
The capital input estimates, I suspect, if we build these things at scale, we'll find a way to come down. And I also think that we will find a way to operate these things in a more energy efficient fashion, because if all of the projections come true, we don't have that much energy.
Exactly. That's why I brought this up, because it takes us right back to that
Yeah.
energy security
Right.
question.
I'm no expert in technology. My suspicion is if there is as much utility in AI as people suggest that there is, and if as much money gets thrown at it as they are suggesting will be thrown at it, that technology probably will solve half the energy problem, which interestingly doesn't derail the energy case. There are
No.
1 billion people on Earth, not AI hyperscalers, by the way, poor people, that have no access to primary electricity. And I think we solve that problem over the next 20 years. So energy demand is going to take care of itself. Some of your younger listeners will say, yeah, but that's going to be alternative energies. It's going to be solar and wind and biomass and all that kind of stuff. And to those people, I need to say that over the last 45 years, humankind has invested about $10 trillion in alternative energy generation. And we've reduced the market share of fossil fuels from a high of 83% all the way down to 81%. And if the prognostications by the big thinkers of the world are even remotely true, we don't have that much energy, and we don't have the capacity to have that much energy.
Everyone talks about demand projections, but almost nobody talks about whether the energy exists to support them. As Rick Rule points out here, scale changes, economics and technology can reduce cost curves, but it cannot eliminate physical constraints overnight. The contradiction is that markets price abundance while infrastructure still behaves like scarcity. Investors focused only on software narratives may be underestimating the strategic value of energy and materials. Next, Rick Rule unravels why growth forecasts quietly assume resource conditions that do not yet exist.
There isn't that much energy. Some of us will make a ton of money trying, truly a ton of money trying. But the energy consumption numbers that people are talking about by 2050, we can't do it. We just can't do it. Doing so would require, as an example, more copper production in the next 15 years than has occurred in all of human history. Given that we have underinvested in the copper business for 30 years, we just, in the timelines mentioned, we can't do it. It's impossible. It'll be a hell of a lot of fun trying, but we can't do it. I heard, and copper is one way to play energy, and of course, it's also a way to play these hyperscalers. At Metals Week in London at the end of last year, they published a paper saying that the 10 largest copper companies in the world needed to invest $250 billion over the next 10 years to maintain current output.
Wow.
Current output is in a deficit to current consumption, meaning that you would maintain a deficit against current production in a market where the lowest estimate of demand growth is 1.5% compounded, and the highest estimates that I've seen are 3.5%. It's also worth noting that that $250 billion was constant 2025 dollars, not inflation-adjusted dollars. The point of all this is that no matter what we do, with the possible exception of a synchronized global depression, can derail the rationing of various of these substances by price over time, because it's too late to correct supply shortages in the next 5 to 10 years. It's just too late.
If this timeline holds, shortages will arrive long before the public narrative adjusts. According to Rick Rule, supply constraints become unavoidable when investment cycles lag demand by decades rather than quarters. Markets keep discounting future abundance while current production struggles to meet existing consumption. For wealth preservation, the danger is assuming prices stay stable while the physical system quietly tightens underneath them. Next, Rick Rule exposes why commodity shortages can emerge even during periods of slowing growth.
You look at society's ability to fund ever-increasing demands, we just don't have the capacity. We may want to. You know, I'm all for helping poor folk. But we're going to have to do that privately. At the federal level now, we owe almost $40 trillion. Last time I looked, that was a big number, you know. And
Yeah.
you and I are also a problem because the net present value of unfunded entitlement promises, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number's $120 trillion. So if you add that 40 trillion to 120 trillion, what, you get 160 million, 160 trillion or something? That's interesting because the Internal Revenue Service says the private net worth of American citizens is 172 trillion. So there's only $12 trillion left over. Now, the federal government has assets, but could you imagine me as a bondholder going up and saying, "Yep, I'll take Yosemite, please"?
Yeah.
These aren't collateral.
No.
The U.S. dollar, I mean, the U.S. economy runs on tax receipts.
Well, I don't know if it runs so much on tax receipts as it does just printing money.
I want one of those. That's
Okay,
great.
I'll bring you one.
That's fantastic.
Absolutely. I mean, and it's even easier for them. And once we're digital, they don't even have to use their fingers.
Yeah, they got a bigger machine than you do with that.
Yes, they do. Yes, they do.
The real risk isn't debt itself, it's what policymakers eventually choose to protect from it. What Rick Rule is highlighting is that liabilities and asset values can appear manageable until confidence in future purchasing power begins to crack. The uncomfortable question is whether fiscal promises get honored in real terms or inflated away over time. Savers who ignore that distinction may discover nominal security, and real losses are not opposites.